Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trade. I want to do a quick little video post on the Fed and the market reaction to the Fed today. Obviously, we had two major economic announcements today. You had GDP data that came in at 0.2% growth for the first quarter of 2015, and then you had the FOMC policy statement, which came in pretty much as expected in terms of the Fed maintaining its policy of 0 to 0.25 interest rate. So that was kind of what we expected. We talked about it in prior videos. We also talked about it on the coach's show, so it wasn't really anything that was unexpected in any one of those. I put it in it that my personal expectation on GDP was about 0.5. It came in at 0.2. It'll be interesting to see if that is revised up in later GDP estimates or if it is revised down. But we'll have to wait for another month until we get that type of information. So GDP is kind of slowing in the market. China is slowing in the market. Very concerning. And probably more so to the GDP, which I feel is more important today than the FOMC policy statement, is the initial market's reaction to GDP. Let's first look at that for just one split second here. So I'm going to turn this into a 15-minute chart, and let's look at the GDP data from today. So here's the GDP data. When the GDP data came out, all of a sudden it comes out right here. The market really kind of drives downward as should be expected, but you have this just buy that dip mentality, but it couldn't be maintained, came all the way back down as well. So that was kind of in the S&P 500. If you're looking at the dollar index, which is absolutely just been crushed over the course of the last week and a half. Here's the announcement on GDP, and when you're talking about these economic reports, the value of the dollar or the S&P 500, the dollar is more correlated to the health of the economy than the actual S&P 500 is, because you have a lot more manipulation, in my estimation, in the S&P 500 and the major market indexes than you do in terms of the dollar and the major currencies out there. And so as the GDP data came out, it came in at 0.2. I talked about this yesterday in the coach's show. When you have a hard number that is priced into the market, you usually have a little bit of a simpler, I should say, approach to the news-based trade, because that number is automatically priced in. And as you can see, that the dollar just got absolutely butchered after the report. I mean, when the report came out right here, it was right around 96, and all of a sudden, after the report, just 3 hours later, it's down at 94.75. Which doesn't seem like a lot, but when we're talking about over a % drop in the dollar index, that's a really big move in a currency. And then it kind of stabilized coming into the FOMC event, and then once the FOMC event came out, the market kind of responded back up in terms of the FOMC. And so when we're talking about the GDP specifically, we'll get to the FOMC here in just one second. But when you're talking about GDP, this has really grave type of movements in terms of not only the U.S. marketplace, but in Europe and in the Asian markets. And Japan's market really kind of got hit on the open because of the American GDP number, also the slowing growth in China as well. You also had the Eurozone. Germany's index went down about over 3% today. So the rest of the world, the international markets out there, they really did not take too lightly or kindly, I should say, to the gross domestic product of the U.S. economy. But this is what I expected. I've been talking about it for 2 weeks now. I've been waiting for that GDP number because the economic reports that we've seen leading into this announcement has not been very good. And they might blame it on a harsh winter. That's a bold-faced lie. The national economy simply is slowing down. We're at the top of a marketplace. There's too much money in the system, and it's starting to slow down. So that was kind of the initial reaction both to the dollar and the S&P 500. Here on crude oil when it came out right here at 6:30 right there, as you saw, kind of a muted reaction, and then all of a sudden inventories come out and just an absolutely killer of a day in crude. So crude had a good day. The dollar index did not, and the S&P 500 was I don't want to say it was that drastic, but it is underneath 2100 right now. I do believe the 2100 level is an important number for the S&P 500. So that's kind of the GDP. Now let's talk about the actual the major news of the day that most people think, and that's the FOMC. The FOMC policy statement is it was about 600 words this time. It was a very, very simple report, and they talked about inflation. Inflation isn't where they want it to be. In my estimation, the Fed is just missing the boat there. They printed $4.7 trillion, and inflation is it's not a swing trade. It's not a day trade. It takes a long time for inflation to really start picking up steam. But once it picks up steam, all of a sudden it gets out of control very, very quickly. And so they keep this interest rate low for the last 8 years. They've been printing money, $4.7 trillion in the last 5 years. They're reinvesting the interest on the debt they incur. I mean, and that to me is just absolutely criminal when you're talking about the Fed, who prints money to buy government debt, and the government has to pay them an interest. A private institution, the government has to pay them an interest on the $4.7 trillion in debt that they own, of which they printed in the first place. It's absolutely insane that they can get away with this in American society. If this was 200 years ago, Thomas Jefferson would tell us to pick up the pitchforks and pick up our guns and wave the tyranny sign and all that. But this isn't 200 years ago, and we don't have Thomas Jefferson in Congress or in the White House, and we don't have George Washington leading the charge, who was very, very leery of central banks. But this is what they were referring to with central banks. Central banks are private organizations. They print money. They control the value of the dollar. They print the money to buy the bonds, of which they reallocate the investment on the bonds, of which the government is paying them an interest payment. It's just absolutely insane that we allow these individuals to get away with this. But as a typical American consumer, number one, most of them didn't even know that existed today, which is sad and pathetic to a certain extent. But at the same time, they don't even know. They're absolutely ignorant that the FOMC even exists, let alone quantitative easing and printing of money and reallocating investments and sparking inflation and all this jazz. So that's kind of my soapbox for the day, but that's all. I'll go on to it. Now, in terms of the FOMC announcement here, let's look at the first dollar index. The dollar index took it fairly, not aggressively, not a big movement. Obviously, the GDP data was more important to the dollar than the FOMC, who really did nothing out there. So it kind of went up just a little bit, and now it's just kind of hanging out right now. The S&P 500 was interesting today. Very, very choppy in terms of the movements in the S&P 500. Okay, when the announcement came out right here, the market initially took it just in the first 15 minutes negatively. However, it responded positively and then gave it all back. And that was just kind of the roller coaster of the S&P 500 today. Just kind of went up, went down, went up, and kind of ended down a little bit today in terms of the S&P 500. I don't know if the market knows how to take the Fed right now. Most of the time they take them as dovish. I don't know if they took them that way this time. Most of the articles and most of the pundits out there, they believe the Fed statement was a dovish statement, and they're reading that based on the GDP data. They're reading that based on the economy. What their thought process is that the Fed is not going to raise interest rates with GDP at 0.2 or with unemployment at 5.5 or with consumer confidence dropping and manufacturing dropping and retail sales dropping and consumer spending dropping. And so they're reading the Fed statement based on the underlying economy, because the Fed keeps telling us in the policy statement that they're very data driven. What they mean by that is they're basing all their policy statements on the data that we get from the national economy. And so a lot of people think now, based on where the economy is today, that the Fed isn't going to raise the rates until at least September, maybe October, maybe December, and some actually push it out to 2016. I still think that is a mistake. I still think the June date is a very important date for the FOMC. They've referenced it to a certain extent, and you've heard it from Fed speeches in the past little while. I'm not saying it's going to be in June, but my read on that is the June data, the June date is an important date. There is not a likelihood, but it is possible that the Fed will raise interest rates in June, because I do believe that the Fed wants to raise interest rates. I do believe that they feel that they have to have something to combat the market as it's starting to go back down in the next bear cycle. And so I think there's more to the Fed fund rate and the raising of interest rates than just the data dependent that the Fed states in their monetary policy statement. I think they're actually going to raise interest rates so they have something to combat in the next bear market. And you got to realize when prior to 2008, the Fed was saying these same things in 2006 and 2007 that they've been doing over the course of the last year. And so they're not going to tell us exactly when they're going to raise rates. They're going to tell Goldman Sachs, they're going to tell JP Morgan. They're not going to tell us. I think that the June, there's about a 25% likelihood in June is what I personally give it. And then in September and October, I'm going to increase that to about 75% of an interest rate hike. But I still see that somewhere in this year. And there's nothing that I personally read in the Fed statement today that got me off that policy statement. So that was kind of the marketplace in a whole, very choppy in the S&P 500. The dollar kind of neutral after the initial GDP reaction. It's going to be interesting to see how the dollar reacts, given that the national economy in the U.S. is becoming weaker and weaker. The dollar is showing signs of that weakness, and it's going to be interesting because the euro is now at about a 2-month high against the dollar. The yen held that 119 level. The Swiss franc held their levels as well. So I'm looking at over the course of the next week, I'm really looking at see how the market responds in this neutral capacity right now. It's still struggling to break out of this 2120 barrier, and you're starting to see it kind of slow its momentum right down. So I'm still neutral on the market right now. The dollar index, I'm still neutral on the dollar right now. I do not know exactly what's going to play out in the currency market. That's why we have that Forex report on a weekly basis to make sure we are aware of what's happening not only in the currency but in the marketplace as a whole. So that was kind of the Fed statement and GDP data today. Hope you enjoyed the video, and we'll see you next time. Go over there to Tackle Trading and check us out. See everything we're doing over there, the videos, the blog posts, and all those different scouting reports as well. And we'll see you next time.